Hello, this is Andy Michael, Portfolio Manager with Seven Springs Wealth Group. 2023 has been another dynamic year thus far in markets. Today, I want to show you how Seven Springs Wealth Group is observing markets and how we're approaching investing markets in a landscape that continues to evolve. With that, let's get started. First, we want to look at the equities market. I want to start on this right-hand chart over here to illustrate what we're seeing, which is that U.S. equity and global equity are still relatively attractively valued today, especially when you back out those mega cap artificial intelligence technology names. To illustrate, let's look at this chart. What we're seeing here is that in the S&P 500, the top 10 names make up nearly 1/3 of the index, 31.5%, and yet they're trading at 30.6 times next 12 months earnings. What that means is you pay over $30 to receive in return $1 of expected earnings over the next 12 months. Compare that to the other 490 companies in the S&P 500 that are trading somewhere between 14 to 18 times next 12 months earnings. We also see that on the international side. Here I have the International EAFE Index and the Emerging Markets Index, both trading around 12 times earnings. That 14 to 18 and 12 times earnings, we still see as a very relatively attractive valuation for putting long-term money to work compared to this 31 times that we see in the top 10 names. So bottom line, within equities, even though we've had a run up this year, we still see overall that valuations remain compelling for long-term investing when you in particular back out those top 10 names that have been driving the majority of the market this year. Let's look at fixed income. And really what we want to show here is that there is nearly no yield higher than a 6-month Treasury bill despite taking increasing credit or maturity risk. Let's just start with a 6-month Treasury bill here, circled here at 5.4%. This was an illustrative example as of August 8th. What we see when we go across the right, looking at different maturities, we see that the yields are going down, not up. Conversely, when we go up here and we take on additional credit risk, looking at municipals and corporate bonds, yields are also going down. That 5.4 is the highest yield going across maturities and going across credit risk. So bottom line, within fixed income, we still see these short-range treasuries as the most compelling place to be investing, taking less risk and actually getting more yield. Putting that all together for going forward, how we're investing today, we're using what we call the barbell. So on the left-hand side of the barbell, we have our cash and preservation assets, earning that real yield we just talked about, which is above the last reported CPI report, inflation report of 3.2. So earning positive real yield with our cash and preservation investments. That enables for future market opportunities as well. On the right-hand side, we have those quality dividend growing companies at reasonable valuations. We call that growth, and our custom global equity voyage portfolios. So using those to diversify across industry, region, and company size. Where we're not seeing as compelling evaluations and investment propositions today is that middle, corporate bonds, preferred equities, commercial real estate, private equity. Those are still can be wonderful places to invest on a unique individual basis, and certainly we think that could change over time. But as it stands today, when we're looking for that next dollar of capital to put to work across markets, we really see the compelling valuations being on the barbell, the left-hand side for cash and further on the right-hand side for growth and dividend growing companies. Lastly, I'll leave you with this. We still think for how to put that money to work, that dollar cost average plan is still a very, very powerful program. This chart is simply showing you 2022 and the first half of 2023. This is the S&P 500. And hypothetically, if you were to put money to work around the 15th of every month across 2022 and 2023. I really have two takeaways when I see this chart. First off, If you did this monthly investment program, you're probably glad that you didn't put it all to work at the start. It really helped to smooth out some of the market volatility that we saw in 2022. But on the other side, it did enable that discipline of continuing to put money to work even when times didn't feel good. I remember this June 2022 time period. It was not a fun time period, even though now looking back, it was a very compelling time to put money to work. So it enacts that discipline of continuing to put money to work throughout market volatility without putting everything in at once and may be subject to drawdowns or declines potentially. So again, dollar cost averaging we see as a very compelling way for how to put money to work going forward. That's it for today. If you have any questions, we'd be more than happy to have a conversation, or if someone you know has questions, please contact us today, and we'll see you next time. Thanks for tuning in.